Well, Patrick William and the team at Rixon Capital have found a niche in the market that they've been lending to with success for borrowers and investors. So let's get into the strategy, and Patrick is here with me now. Patrick, hi, nice to see you.
Good to see you, Nadine.
Just picking up on a few things that have come up for the past, few interviews that we've done. Do you feel like you're working in the Wild West, as private credit has been accused of being before?
If you read the newspapers, you'd believe so. But what I tell people is, if you take away the handful of unlicensed fund managers, who you wouldn't call fund managers, and the handful who have sort of breached their fiduciary duties, yes, but the reality is the broader sector is sophisticated, and there are lots of very, very good players out there. So don't believe the hype.
Yeah, you don't look like a cowboy. So with that, though, do you feel at Rixon that increased scrutiny from the regulators, increased regulation even, might be a positive for the industry overall?
I'm a free market proponent, so I think increased scrutiny is good because it puts the sector on notice. But what the sector is better off doing, in my opinion, is self-regulating, agreeing a framework which we all abide by. Because the challenge with the regulation is it seems like a good idea, but regulation always comes at a cost, and there's a cost that the investor pays.
Okay. So what's the niche, Patrick? Where's Rixon operating?
So we found our little patch that no one else will touch. So effectively, we lend to SMEs and emerging corporates looking for loans of under $20 million. So we're able to get asset-backed loans where borrowers pay us cash interest every month at rates in excess of 13% per annum, which sounds too good to be true. The way we access that is those borrowers are looking for check sizes that are too small for the banks or the billion-dollar funds. So they're great credits, but because they want, say, $5 million, a billion-dollar fund cannot spend time on a $5 million loan. It's a waste of time.
So you're talking even just doing due diligence on a loan size between 1 and
1 and 20.
20 million.
It's a waste of time for them. Yeah.
Okay, so you have found this little niche in the Australian market. Just talk to us through the investment mandate, I suppose.
Yeah, so it's prescriptive. So it's a very clear rule book. All our loans are first ranking, senior secured, completely asset backed by tangible assets, plant, property, equipment, receivables, and interest paid monthly in cash. We're forbidden from lending into the property developed space, and what's quite notable is we're forbidden from taking equity upside in the borrower. And that ensures we're aligned, right? Because when we're doing the diligence, we're not worried about how well the borrower is going to do, in the sense that if they might turn the next Amazon, we get to ride on their coattails. Because we're pure credit, we focus on downside. Doesn't matter how good you're going to be, I just want to make sure you pay your interest every month. At the end of 2 to 3 years, we get our money back.
Yeah, okay, so pure debt, no equity warrants, no distractions. Like, how much of this is there out there for you to tap into in terms of the market? I mean, what types of businesses are we talking about?
We do a lot of lending to lenders. So think Zip Money or Aussie Home Loans in the early days. Today they've got billion-dollar warehouses. But when you need that first $20 million warehouse to build scale, most people in the market will say, look, I want 10% of your business to give you that warehouse. We turn up and say, look, we'll give you the $20 million. We won't take your equity, but we'll get a really low LVR. We'll charge you a higher price. But it's worthwhile because we're taking them on a journey where at the end of 3 years, we've created incredible wealth for those shareholders.
So we've got a slide up on screen. I think that this is always an interesting one for me personally. I hope it is for our viewers as well. But you get a lot coming across your desk, right?
An incredible number of deals. That puts the grays in my hair. So you look at those numbers, right? 335 potential interested borrowers over the last 2.5 years, and we've done 17.
Right.
So tons of Q&A, lots of due diligence. So we've got a dedicated credit team, and that's all they do all day long.
So in the debt recovery stack, just to be clear, you come first?
Yes,
and
always.
You've got assets, so it's asset-backed, meaning that if you need to do a recovery or workout, you'd have something to sell. That's
the concept. So if things go bad, there are no earnings to recover anymore. So we work on the basis that they've got, or we've identified assets that are there that will retain value even if the business has gone the wrong way. So we can monetize that and get 100 cents on the dollar back in a timely manner.
Mm-hmm. have you had to do that very often?
Thankfully, we haven't ever had to do that.
What?
So I've done this for about 8 years across 3 strategies. So we only have had one borrower wobble. And again, because of good due diligence, we lent to a corporate that was asset rich. But because of regulatory risk around it, we said, look, can you give us additional assets? And he gave us a small portfolio of motels in South Australia. When the lockdowns came in COVID, the business revenue went to 0. He sold 2 of the motels and we got all our money back within 8 weeks. So that's the premise of our proposition.
Yeah. So you mentioned COVID, and I think that's just made me think about macroeconomic conditions and how that's either a tailwind or a headwind for your strategy, or doesn't matter whether or not Australia is in, a per capita recession or Australia is in a slow growth environment. There's still these types of enterprising people and enterprising companies that are looking for funds.
That's fair. So I would say it's irrelevant. And the reason for that is businesses that can boom and bust don't suit our mandate. Because when we run that downside scenario and you can lose 50% of your revenue in 12 months, well, that's not going to give us comfort. So I'd describe most of our borrowers as acyclical businesses.
Interesting. So we've got a slide that you provided when it comes to performance. So you're talking about unashamedly saying we'll give you this money, but we're going to charge a pretty healthy interest rate for you to have it. So what type of performance has that led to?
Look, for investors, fantastic. It's like 0.94 to 1% a month net cash over the last 12 months. So it's 11.6% for the last 12 months net on an asset-backed portfolio, which really makes it very compelling.
Okay, a couple questions have come in.
Yep.
James says, how do you target rates like this without risky or volatile investments? I think you sort of answered that before, but just flesh it out for us a little bit.
Yes. So there are 2 elements to that. So that is a very good question. So first, people tend to think that the only way to get a high return is through a risk premium. We get that high return through a scarcity premium. When there is no capital in the market and the only people who want to look after you want part of your business, you're happy to pay a higher price, not because of risk, but because your cost of capital is 40%. I'm happy to pay you 15. That's one. The second is we don't gear to the gills, so there tends to be a lot of cash flow, number one. Number two, when you lend to lenders make 30 to 100% annualized interest rates on those books. So 15% per annum on that is a drop in the ocean.
Okay, interesting. For Julia, this is a good one. Have you ever missed a target rate monthly payment?
No, never. And again, there are 2 reasons for that. One is it's an income fund. All the interest is paid every month. We've got a third-party trustee, a third-party fund administrator. So it's out of our hands. The machine takes over and distributes the capital. But from the credit standpoint, we've got bulletproof documents and we're first ranking senior of our borrowers. So our borrowers know we're great partners, we're there to help them grow, but if they miss a payment, we'll pull those documents out and exercise our rights. And it becomes a lot less friendly then. So they understand that money's got to be in the bank account at the end of the month.
Okay, so just talking a little bit more about what could change if we do see changes in regulation coming from ASIC, and I know that you want the industry to self-regulate, but that might not be possible. Is there anything that you can foresee that might put the area in which you operate in at risk?
From what we understand, we should be all right because we're a wholesale fund. And ASIC's real focus is on protecting retail investors. So at the end of the day, wholesale funds target investors who are obliged, if you like, to read the documents, and if there is ambiguity, and there's a lot of ambiguity in the market, ask the right questions. Whereas retail investors are protected by ASIC. So I expect most of that regulation will focus on that retail segment.
Yeah, and so how is demand going right now in terms of, well, you could talk about from the investment side or from the borrowing side as well, because it's just such a symbiotic relationship.
It is. Look, it's going very, very strong. You can tell by the smile. The borrowers like us. We've got a good market profile, so people know to come to us when you're looking for that non-dilutionary debt in that growth phase of your business. We've got directors of borrowers recommending us to other businesses, boards of which they sit. And from the investor standpoint, the beauty of our model is it's a cash payment every month. So, there's no excuses to be made. There's no sales pitch. It turns up on the 6th business day like clockwork, and people just keep topping up or telling their friends.